Today, we are analyzing the Nifty 50 following the July 7th weekly expiry. Our goal is to evaluate the current market structure using price action, Fibonacci levels, and options data to formulate a trading plan for the upcoming session. The headline index closed at 24,398.70, down about 31 points. However, the candle tells a more dramatic story. We saw an intraday rally to nearly 24,540, followed by a sharp reversal in the final 45 minutes to close near the day's low. This suggests short-term exhaustion at the 24,500 to 24,600 resistance shelf, even though the medium-term uptrend remains intact. To analyze markets with the best tools and charting experience, we suggest using the Dawn trading platform. Use referral code EJZZI96380 for exclusive benefits. To understand the severity of this reversal, let's look at the shorter time frames. On the 15-minute chart, the rejection is unambiguous. After a steady grind higher throughout the day, the price hit a wall at 24,530. The subsequent sell-off was vertical, leading to what we call a classic weak close pattern. In technical analysis, when a market closes near its session low after hitting a new high, it often signals that the buyers have been overwhelmed and a further correction or consolidation is likely in the next session. For the July 8th session, this 24,396 to 24,440 area is our critical pivot zone. Staying below this suggests the bears have taken the steering wheel for the short term. For the best trading experience and advanced analysis, I suggest using the Dawn trading platform. Use referral code EJZZI96380. To manage our risk and set realistic targets, we use Fibonacci levels anchored to the recent price action. Using the high-low range of the expiry session, we can identify where the price might encounter friction. The first zone of interest is between 24,396 and 24,422. This is the initial retracement area and acts as our near-term pivot. If the price fails to stay above this, the bearish momentum is likely to continue. Moving higher, the mid-retracement zone between 24,442 and 24,463 is crucial. The bulls must reclaim and hold this level to regain control and negate the expiry day sell-off. Finally, 24,530 stands as the ultimate ceiling. It represents the session high and is currently a major wall of resistance. If the weakness persists and we break below the session low, we look at extensions for support. The first cushion sits at 24,307. A more decisive level is the 100% extension at 24,180. Breaking below this opens the door for a much deeper correction toward the psychological support of 24,000. For the best trading experience and analysis, use the Dawn trading platform. Use referral code EJZZI96380. Beyond the charts, we must look at where the big players are placing their bets. We do this by analyzing the options open interest for the July 14th expiry. Open interest, or OI, tells us the total number of outstanding derivative contracts. Think of these as walls that the price has to climb or break through. Notice the massive concentration of call OI at the 24,500 strike. When traders write or sell calls at this level, they are betting that the price will not go above it. This makes 24,500 the single largest resistance concentration on the chain. On the flip side, we have the heaviest put OI at 24,000. This acts as our key support cushion for the week. The put-call ratio currently stands at 0.91. Since this is slightly below 1, it indicates that more calls are being written than puts, signaling a mildly bearish to neutral market sentiment. Finally, the max pain level is at 24,400. This is the strike price where the most option buyers would lose money. Price is often magnetized toward this level as we approach expiry, which aligns perfectly with our identified pivot zone. For the best trading experience and advanced data analysis, I suggest using the Dawn trading platform. Use the referral code EJZZI96380 to get started. To confirm if the sell-off was a fluke or a structural shift, we use the Z-score momentum indicator. The Z-score measures how many standard deviations the price is from its mean. During the rally from 24,000 to 24,530, the Z-score was pinned between +2 and +3. Statistically, this is extreme territory, meaning the market was severely overbought. Look at the final candles of the session. The Z-score literally fell off a cliff, dropping from +1.4 down to -0.37. This collapse matches the sharp red price candle exactly. It confirms that the sell-off was a genuine loss of momentum and not just a thin price wick. If the Z-score stays below 0 during the next session, it supports a continuation of weakness. However, a quick reclaim of the +1 level would suggest that the drop was just a one-day flush within a healthy uptrend. Monitoring this momentum reset is key to deciding whether to stay bearish or look for a reversal. For the best trading experience and advanced technical analysis, we suggest using the Dawn trading platform. Use referral code EJZZS96380. A move in the Nifty 50 is only as strong as the stocks that drive it. By looking at the top-weighted constituents, we can see if the reversal was a broad market event or just a fluke in one sector. Notice the relative performance over the last week. HDFC Bank, Bharti Airtel, and ICICI Bank all significantly outperformed the index, showing gains between 3.2 and 3.8%. Reliance Industries, however, was the laggard, up only 0.56% and showing much higher volatility. Despite their different strengths throughout the week, look at the right edge of the chart. All four major leaders, including the heavy-hitting banking stocks, rolled over together into that final red candle. This is a critical observation, because the reversal was broad-based and index-wide, rather than isolated to a single stock. It carries much more weight. It tells us that the selling pressure was systemic across the largest components of the market, reinforcing our cautious bias for the upcoming session. If Reliance continues to be the weak link, it could drag the entire index down even if the banks try to hold their ground. For the best trading experience and market analysis, we highly suggest using the Dawn trading platform. You can use referral code EJZZI96380 when signing up. While we focus on the Indian market, we cannot ignore the global backdrop. The overnight U.S. session often sets the tone for our morning opening. Looking at the most recent data, the U.S. markets closed weak. The Nasdaq 100 was the hardest hit, down nearly 1.87%, signaling significant weakness in the technology and growth sectors. Simultaneously, the U.S. dollar index, or DXY, saw a mild rise. In the world of emerging markets like India, a rising dollar is typically a headwind, as it can lead to capital outflows by foreign institutional investors. Furthermore, the U.S. Volatility Index rose by over 5%, indicating a meaningful shift toward a risk-off sentiment globally. A weak U.S. close, led by a tech sell-off and rising volatility, typically translates into a soft to negative opening bias for the Nifty 50. This global data reinforces the technical caution we've observed on our own domestic charts. For the best trading experience and in-depth analysis, use the Dawn trading platform. Sign up using the referral code EJZZI96380. Now, let's look at a very interesting piece of the puzzle, the India VIX. While the U.S. markets showed rising fear, the domestic story is a bit different. Unlike the U.S. VIX, the India VIX actually fell during the expiry session, closing at 11.65. To put this in perspective, this is very close to its one-year low of 8.72 and nowhere near its one-year high of 28.91. This is a crucial, slightly contrarian data point. A low and falling India VIX means that the local options market is not pricing in significant fear or expecting a massive, outsized move tomorrow, despite that sharp reversal candle we saw earlier. This low volatility environment argues against a violent, panic-driven gap down. It suggests that if we do see weakness, it is more likely to be an orderly, choppy pullback rather than a total breakdown of the market structure. It keeps the medium-term bullish outlook alive while we navigate this short-term exhaustion. For the best trading experience and advanced market analysis, we suggest using the Dawn trading platform. Use referral code EJZZI96380 to get started. Now, let's bring everything together into a concrete trading plan for July 8th. We have 4 primary scenarios based on how price reacts to our pivot zones. In Scenario 1, if the price opens or stays below the 24,396 to 24,420 zone, bearish continuation is the highest probability path. You should look to sell into any bounces toward 24,460, targeting the Fibonacci levels of 24,247 and 24,180. Keep your stop loss strictly above 24,500. In Scenario 2, if the price reclaims and holds above 24,440, the max pain zone, expect a push toward 24,500. However, treat this as a sell-on-rise zone. Unless we see massive volume, that 24,500 call wall will likely act as a heavy lid on the market. Scenario 3 is a breakdown below. 24,180. If this level fails, it opens the path to the major put support at 24,000 and potentially the late June consolidation shelf near 23,800. Finally, Scenario 4 is a breakout above 24,600 with high volume. This would completely invalidate our bearish view and open an extension target of 24,864. Regardless of the scenario, do not front-run the open. Wait for the first 15 to 30-minute candle to confirm the direction before committing your capital. For the best trading experience and advanced data analysis, use the DAN trading platform. Use our referral code EJZZI96380 to get started. To capitalize on these scenarios, we can look at a few specific strategy ideas. Because the India VIX and implied volatility are historically low, buying options premium is relatively cheap right now. If we see a break of 24,300 with strong momentum, a bear put spread using the 24,350 and 24,300 strikes could be an effective way to play the downside while managing risk. For a more conservative approach that benefits from time decay, a bear call spread selling the 24,500 call and buying the 24,600 call aligns perfectly with the heavy call writing wall we identified earlier. This strategy profits as long as Nifty stays below the 24,500 resistance. If the first hour of trading shows no clear directional break and the price stays near the 24,400 max pain level, a tight iron condor between 24,300 and 24,500 could suit a range-bound view. This is ideal for a choppy to soft session where the low VIX prevents a runaway trend. In conclusion, maintain a cautious bias, keep an eye on the 24,400 pivot, and watch for a potential VIX spike at the open to confirm any bearish continuation. For the best trading experience and high-level technical analysis like we've seen today, I highly recommend using the DAN trading platform. It offers an incredible interface with built-in TradingView features and deep options data. You can get started today by using the referral code EJZZI96380. Happy trading and stay disciplined.